Imagine this. You buy a coffee. Tap. Done. The barista smiles. Your phone shows a tiny deduction, and somehow, money appeared out of nowhere. Not from your account balance, not from a vault somewhere, not from the government, but it exists now, digital, ready to spend. You probably never thought about it, but every time this happens, a quiet miracle or a quiet illusion is taking place. Who is really creating that money, and why does it matter more than your morning latte? Because here's the thing, most of the money in the world isn't physical, it's numbers in a ledger. Numbers that somehow appear and disappear at the touch of a screen. And that process, how money actually comes into being, shapes everything. The price of your rent, the interest on your loans, the stability of economies. And yet, almost nobody understands it. Today, we're going to pull back the curtain, and what you'll see might feel a little unsettling. Most people assume money is created by the government, paper bills, coins, printed and minted in a factory. But that's a tiny fraction. Physical money, cash, makes up less than 10% of all money in most developed countries. The real money lives digitally, and most of it is created by banks. Not the central bank, not the government, the ones that hand you loans, mortgages, and credit cards. Here's the core trick. When a bank gives you a loan, it doesn't pull out stacks of cash from a vault. It writes a number in your account. That number? Congratulations, it's money. It didn't exist before. Say you want a $20,000 car loan. You sign the papers, the bank hits enter. Your account shows $20,000. That $20,000 is now real money you can spend. It came from thin air, backed by your promise to pay it back. Banks create about 97% of the money in circulation this way. The government mostly just hands out coins for show. So next time you swipe your card, think about this. Your purchase doesn't just move money around, it triggers the system that made that money in the first place. Your payment tells banks, yes, create more money, or shift money here, shrink it there. Every transaction is a tiny vote in a giant money creation machine. And here's the subtle irony. The more you spend, the more the system depends on your spending to survive. Now let's talk numbers. The banking system runs on something called fractional reserve banking. It's simple in concept, but shocking in effect. Banks are only required to keep a fraction of deposits on hand, often 10% or less. That means if you deposit $1,000, the bank can lend out $900. That $900 loan becomes a deposit elsewhere. Then, 90% of that can be lent again and again and again. A single $1,000 deposit can ultimately create over $9,000 of new money, and you never touched a dollar outside your first deposit. Economists love to talk about money supply growth like it's a controlled scientific process. In reality, it's messy, human, and dependent on trust. If banks stop lending, money supply slows. If people stop borrowing, economies stall. And yet billions of dollars in new money appear daily, almost invisibly, by systems most of us never see. This is why inflation, bubbles, and crises happen. When too much digital money chases too few goods, prices rise. When banks get reckless, loans turn sour and the machine wobbles. And because most money is created as debt, it must eventually be paid back with interest. This creates a constant pressure on individuals, businesses, and governments to borrow more just to keep the system functioning. It's a subtle trap disguised as convenience. Every card swipe, every loan, every mortgage is a small part of a massive, fragile ecosystem. Zoom out, the money you think you own is largely a promise, a claim on future labor, rather than a concrete thing. Governments and central banks can tweak the system, pump new digital money, or raise interest rates, but the underlying power lies with the network of commercial banks. They are, quietly, the largest creators of money in the modern world. So when economists talk about quantitative easing or money printing, they're only talking about a small part of the story. Most money never comes from a printing press. It comes from contracts, trust, and the invisible ink of ledgers. Next time you swipe your card, pause for a second.
Think about the $5 coffee, the invisible strings, the digital alchemy that made it possible. Money is more than paper or metal. It's a story we all participate in. And the question remains, if almost all money is created by debt, what happens when the world decides it can't pay anymore? The machine hums along, but one day, maybe, someone will pull the plug, or it will pull itself.